Did you know that 90% of retail traders lose 90% of their funds in their first 90 days? It is a statistic that has haunted the financial markets for decades. Yet, the industry keeps peddling the exact same advice. You have heard it 1,000 times. Risk 1 to make 3. They call it the holy grail of risk management. They tell you that you only need to be right 30% of the time to become a millionaire. It sounds perfect on paper, doesn't it? A mathematical guarantee of wealth that seems impossible to break. But if it is so simple, why is everyone blowing up their accounts? The reality is that the 3-to-1 risk-reward ratio is a siren song designed to lure you into a psychological meat grinder. It ignores the fundamental nature of market volatility and the fragility of human emotion under stress. While you are sitting there waiting for that massive home run trade, your account is bleeding out from 1,000 paper cuts. The gurus will not tell you the truth, but the math you are relying on is fundamentally flawed from the start.
Is a 3-to-1 reward ratio actually statistically superior, or is it just a beautiful lie? Let us look at the raw probability distribution. In a perfectly efficient market, price movement is effectively a coin flip, meaning a 50-50 probability of moving up or down. However, when you demand a 3-to-1 return, you are mathematically forcing your required win rate to drop significantly below 30% to maintain an edge, once you factor in spreads and commissions. You are fighting against the natural entropy of the market. To hit a target 3 times your risk, price must travel 3 times the distance without hitting your stop loss. In the chaotic noise of intraday trading, the probability of price moving 1 unit against you is exponentially higher than it moving 3 units in your favor without a retracement. You are betting on outliers in a game dominated by mean reversion. While you chase the unicorns, the 1-to-1 traders are banking on the most probable outcome. But to understand why this fails, you have to look at the devastating impact of the losing streaks that high-reward systems guarantee.
Can you handle losing 15 trades in a row without breaking your rules? If you trade a system with a 30% win rate, which is typical for a 3-to-1 strategy, statistical probability dictates that you will eventually face a losing streak of 15 to 20 trades. It is not a matter of if, it is a matter of when. Imagine the psychological toll. Day after day, you watch your equity curve plummet. You start doubting your system. You start doubting yourself. This is where the retail trader breaks. They start revenge trading, widening stops, or skipping valid setups just to avoid another loss. By the time the winning trade finally arrives, you have likely abandoned the strategy or blown the account entirely. This is the hidden cost of high risk-reward ratios. They require the discipline of a machine, but you are a human being with a pulse and a mortgage. The math might work over 10,000 trades, but you will be insolvent before you reach trade number 100. And the market's natural behavior makes these long runs even harder to catch.
What if I told you that markets only trend 20% of the time? The other 80% of the time, the market is chopping, grinding, and ranging sideways. A 3-to-1 risk-reward ratio is inherently a trend-following metric. It requires an explosive move to reach your target. But since the market spends the vast majority of its life stuck in consolidation, your high-reward targets are constantly just out of reach. You watch price go 2-to-1 in your favor, only to violently reverse and stop you out. It is the most frustrating experience in trading. You were right about the direction, but you were greedy about the destination. The market does not care about your target. It cares about liquidity and equilibrium. By demanding a massive extension on every trade, you are trying to force a ranging market to act like a trending one. You are fighting the ocean's current. The 1-to-1 trader, however, recognizes that volatility is limited. They take what the market is willing to give, but there is a specific reason why their targets get hit with such frightening consistency.
Why does a target of 1-to-1 dramatically shift the probability in your favor? It comes down to the path of least resistance. For a 1-to-1 trade, the price only needs to move a standard deviation in your direction. It is a low-energy request. You are asking the market to do something it does every single day: fluctuate. When you aim for 1-to-1, your win rate naturally gravitates toward 55 or 60%. assuming you have even a basic edge in technical analysis. Suddenly, you are winning more often than you lose. You are no longer hunting for a needle in a haystack. You are gathering the hay. This shift in win rate changes everything. It changes your cash flow, it changes your confidence, and it changes your ability to compound. Instead of waiting weeks for a winner, you are stacking wins daily. You are aligning yourself with the high-frequency noise of the market rather than fighting it. But the real magic happens in your brain, where a chemical reaction is about to dictate your success or failure.
Are you addicted to the rush of a big win or the consistency of a paycheck? Your brain runs on dopamine, a neurotransmitter that rewards success and reinforces behavior. In a 3-to-1 strategy, you are starving your brain of dopamine for long periods. You suffer loss after loss, creating a cortisol-fueled stress loop that degrades your cognitive function. When you finally hit that big winner, the relief is overwhelming, but it creates a gambling addiction mentality. Contrast this with the 1-to-1 approach. You win frequently. You get a steady drip of dopamine that reinforces good habits and confidence. You feel like a winner because you are winning. This positive feedback loop is essential for maintaining the flow state required for peak performance. A confident trader executes without hesitation, while a fearful trader freezes. By securing frequent wins, you are hacking your own biology to support your trading career. You stop fighting the charts and start flowing with them. However, to maintain this high strike rate, you must understand the dangerous game played by the market makers.
Have you ever wondered why price reverses exactly 1 pip past your stop loss? This is not bad luck. It is a mechanism of the market known as a liquidity hunt. High-risk reward traders usually employ tight stop losses to justify their massive position sizes. These clusters of tight stops are visible to institutional algorithms. They are pools of liquidity that smart money uses to fill their large orders. By aiming for 3-to-1 with tight stops, you are essentially painting a target on your back. You are providing the liquidity for the banks to enter their positions. The 1-to-1 trader, however, can afford a wider, more structural stop loss because they are not trying to squeeze a diamond out of a lump of coal. They place their stops behind significant barriers where the institutions are defending price, not where they are hunting. By stepping out of the retail kill zone, you survive the volatility spikes that wipe out the dreamers. But survival is just the first step. Now we must look at the explosive power of compounding.
How fast can you double your account if you are waiting 3 weeks for a single win? The speed of compounding is directly related to the frequency of your opportunities. A 3-to-1 strategy might offer a great return per trade, but if valid setups only appear twice a month, your capital is stagnant. Money has a time value. A 1-to-1 strategy, which capitalizes on smaller, more frequent market moves, allows for a much higher turnover of capital. You can place a trade, hit your target in an hour, and free up that capital for the next opportunity. This is called velocity of money. Even with a smaller return per trade, the ability to compound those gains daily creates an exponential growth curve that leaves the swing trader in the dust. You are turning your inventory over faster. Retail traders obsess over the size of the win, but professionals obsess over the frequency of the turnover. While the sniper waits all day for one shot, the machine gunner has already cleared the field. But there is a hidden trap in holding trades too long. Did you know that every second you are in a trade, your risk of a black swan event increases? Time is a risk factor that almost no retail trader calculates. The longer you hold a position to try and reach that distant 3-to-1 target, the more you expose your capital to unexpected news events, tweets, algorithmic flashes, and geopolitical shocks. A trade that stays open for 3 days has infinitely more exposure to chaos than a trade that closes in 30 minutes. The 1-to-1 trader minimizes time in the market exposure. They get in, capture the probability, and get out. They sleep soundly at night because they are flat cash. The 3-to-1 trader is often stuck holding positions overnight or over weekends, subjected to gaps that can blow past stop losses and wipe out accounts. Reducing the duration of your trades is the ultimate form of defense. You are guerrilla warfare. You strike and vanish. But to execute this, you need to understand that being right is not enough. You need to be precise.
Are you trying to catch the exact top or the exact bottom of every move? The obsession with high risk-reward ratios forces traders into a perfectionist mindset. To get a 5-to-1 return, you have to enter at the absolute beginning of a trend and exit at the absolute peak. This is a fool's errand. Markets are messy. Support and resistance are zones, not lines. When you aim for 1-to-1, you do not need to be perfect. You just need to capture the meat of the move. You can enter a bit late and exit a bit early and still bank the profit. You are allowed to be imperfect. This margin for error is vital for longevity. It reduces the stress of execution. You stop trying to be a wizard and start being a business operator. You are capturing the easy middle portion of the move where the momentum is undeniable. However, skeptics will argue that 1-to-1 has a fatal mathematical flaw if your win rate drops. So let us crush that argument right now.
Does a 50% win rate really mean you break even? The critics of 1-to-1 claim that if you risk 100 to make 100, you need a win rate over 50% just to cover commissions. This is technically true, but it misses the bigger picture of expectancy. With a 1-to-1 strategy, your win rate should not be 50%. It should be 60, 65, or even 70% because the target is so much easier to hit. Achieving a 60% win rate on a 1-to-1 strategy is significantly easier than achieving a 35% win rate on a 3-to-1 strategy. The hurdle is lower. Furthermore, active trade management allows the 1-to-1 trader to cut losers short before they hit the full stop loss, effectively skewing the ratio back in their favor. You are not a robot blindly taking full stops. By managing the downside actively while banking consistent upside, the math tilts heavily toward profit. But there is one psychological trap that kills the high-reward trader faster than anything else: the greed of the open profit.
How many times have you watched a trade go $500 in profit, only to close it for a loss? This is the hallmark of the 3-to-1 mentality. You are up significantly, but your plan says, hold for the home run. So you hold. The market retraces. You are still up 200. You hold. It goes negative. You panic and close. You turned a winning day into a losing day because you were greedy. This destroys your psyche. The 1-to-1 trader banks that $500, period. It is in the bank. It is realized equity. They do not care if the market goes another 1,000 points without them. They have secured the bag. Over the course of a year, the amount of give-back profit that high-reward traders lose is staggering. It is likely more than their total net profit. Learning to pay yourself is the most important skill in trading. You cannot spend unrealized gains. But to trade this way, you have to stop listening to the institutional narratives designed to keep you poor.
Why do big banks never talk about risk-reward ratios? Because they focus on Sharpe ratios and win rates. High-frequency trading algorithms operate on margins that are often less than 1-to-1, yet they print money every single day. They rely on the law of large numbers. They take thousands of trades with a slight edge and let the volume do the work. The risk-reward mantra is largely a retail education invention used to sell courses to people with small accounts. They sell you the dream of turning $1,000 into $100,000 quickly. That requires high leverage and high reward targeting. And it requires luck. The institutions are playing a game of consistency, not lottery tickets. If you want to trade like a professional, you need to stop trying to hit jackpots and start running a casino. The house always wins because the house has a small edge played out over millions of spins. But how does this affect your emotional state during a trading session?
Is your emotional bank account overdrawn? Trading consumes mental energy. Every decision, every tick of the chart drains your willpower. A 3-to-1 trade that grinds on for hours or days holds your emotional capital hostage. You are constantly checking your phone, stressed, distracted from your real life. When that trade finally loses, the emotional bankruptcy is severe. A 1-to-1 trade is quick and decisive. The resolution comes fast. This preserves your emotional capital. You finish your session with a clear head. You are not carrying the baggage of open positions or the trauma of near misses. Protecting your mental state is just as important as protecting your wallet. Burnout is the #1 career killer for traders. By adopting a strategy that minimizes stress and maximizes closure, you are ensuring you will still be in the game 5 years from now. Now, let us look at the specific market conditions where 1-to-1 dominates the competition.
What happens when the market enters a high volatility chop fest? During news events or market opens, price whipsaws violently in both directions. The 3-to-1 trader gets stopped out on the wicks before the move happens, or they get stopped out on the reversal. Their tight stops cannot survive the noise. The 1-to-1 trader, however, thrives here. They use the increased volatility to hit their targets instantly. The noise is actually their signal. They capture the expansion moves that happen within the range. While the trend followers are getting chopped to pieces waiting for a breakout that never comes, the 1-to-1 scalper has already extracted profit from the chaos 3 times over. You are monetizing the market's indecision. In a world where algorithms are designed to fake out breakouts, playing the range and the quick impulse moves is the only way to stay safe. But to do this, you must completely change how you view your stop loss.
Do you view your stop loss as a failure or as a business expense? In a 1-to-1 system, the stop loss is simply the cost of doing business. Because your win rate is high, a loss does not sting as much. It is easily recovered by the next trade. In a 3-to-1 system, a loss is a significant setback because wins are so rare. This makes you hesitant to take the loss. You move the stop. You bargain with the market. In the 1-to-1 model, the stop loss is wider and structural. It gives the trade room to breathe. You are acknowledging that you cannot predict the exact turning point, so you are paying for the privilege of a wider error margin. This changes your relationship with losing. It becomes mechanical, not emotional. You stop fearing the red and start respecting the process. But be warned, this strategy requires a radical shift in how you measure your success.
Would you rather have a jagged, heart attack-inducing equity curve or a smooth, steady ascent? Investors and prop firms do not just look at total profit. They look at the volatility of your returns. A 3-to-1 strategy creates a staircase down, elevator up equity curve. It is filled with deep drawdowns followed by sharp recoveries. This is uninvestable for serious capital. It shows a lack of consistency. A 1-to-1 strategy creates a smooth, upward sloping equity curve. The drawdowns are shallow because the losing streaks are short. This is the holy grail for prop firms. They want consistency, not heroes. If you want to get funded and stay funded, you need to show that you can control risk and produce steady gains. The jagged curve of the high reward trader is a red flag that screams gambler. The smooth curve of the 1-to-1 trader whispers professional. But how do you actually execute this without getting eaten by fees?
Is your broker getting rich while you stay poor? It is a valid concern. High-frequency 1-to-1 trading generates more commissions than swing trading. If you are scalping for 5 pips with a 5-pip stop, the spread and commission will eat your edge alive. This is why the 1-to-1 strategy must be adapted for volatility. You are not looking for 5 pips. You are looking for 20, 30, or 50 pips with a matching stop. You need enough range to render the spread negligible. You must trade liquid assets during peak hours. You treat the commission as a variable cost that is offset by the high win rate. Do not let the fear of fees push you back into the arms of the 3-to-1 fallacy. The cost of a few commissions is nothing compared to the cost of the losing streaks you are currently enduring. But now, we arrive at the most difficult part of this transition, ignoring your ego.
Can you handle your friends bragging about a 10-to-1 crypto trade while you grind out your daily bread? Trading 1-to-1 is not sexy. It does not make for great screenshots on social media. It is boring, repetitive work. It is blue-collar trading. The retail industry is built on the glitz of the giant win. By adopting a 1-to-1 mindset, you are killing your ego. You are admitting that you cannot predict the future, that you are not a market wizard, and that you are just here to extract a salary. This is why most fail to stick with it. They want the glory. They want to be the hero who called the top. You have to decide if you want to be right or if you want to be rich.
The rich trader is the one quietly clicking buttons, taking small chunks and compounding their account while the hero blows up for the third time this year. But if you are ready to make the switch, here's the roadmap.
Are you ready to unlearn everything you have been taught? The transition to one-to-one requires a complete rewiring of your brain. You must stop looking for the home run. You must start celebrating the base hit. You need to re-backtest your strategies with this new parameter. You will likely find that setups you thought were losers are actually winners if you just took the profit earlier. You need to adjust your position sizing to respect the wider stops. You need to embrace the boredom of consistency. It will feel wrong at first. You will feel like you are leaving money on the table when a trade runs further. But you must look at your monthly statement, not the individual trade. The numbers will not lie. The consistency will calm your nerves. You are moving from gambling to engineering. And now, the final piece of the puzzle, the execution plan that starts tomorrow.
Will you keep chasing the ghost of the perfect trade, or will you start building real wealth? The evidence is overwhelming. The math of probability, the psychology of the human brain, and the structure of the market all favor the one-to-one risk-reward ratio for the retail trader. It is the path of least resistance. It bridges the gap between the novice and the professional. It keeps you in the game long enough to master it. Tomorrow morning, when you sit down at your charts, do not look for the lottery ticket. Look for the probability. Set your target equal to your risk. Watch how it gets hit. Watch how your confidence grows. Watch how your account stabilizes. The era of the 3-to-1 lie is over for you. You have seen the truth behind the curtain. The market is a river of money. You don't need a bucket. You just need a cup, and you need to dip it in often. Welcome to the side of the consistent winners.